All right, we're going to talk about what might just be the single most important number in all of finance. Seriously, it's called the equity risk premium. Think of it as the hidden engine behind, well, pretty much every stock valuation. Understanding this one number is absolutely key. So, what is it?
Okay, let me ask you a question. Just think about this for a second. Let's say you've got an investment that's totally guaranteed, right? Risk-free, and it pays you 2%. Now, I come along and say, hey, how about we move that money into the stock market, with all its ups and downs? How much more than that 2% would you need to see? What's the extra return you'd demand to make that leap? Just get a number in your head.
Got your number? Okay. That little bit extra you just demanded, that something more you needed to be convinced, that is the equity risk premium. It's that simple. It is literally the price of taking on risk. It's the reward you want for stepping away from that safe, guaranteed investment.
So let's put a slightly more formal definition on it. The number you came up with, that's your personal equity risk premium. But when we talk about the equity risk premium, what we really mean is the consensus, the average answer from all investors out there. It's the extra return that the market as a whole demands to pick stocks over something totally safe like a government bond.
So, what actually drives this number? Well, it's definitely not set in stone. It's constantly moving. A piece of it is just your own personal comfort level with risk. But the really big driver is how everyone feels about the world. When the economy looks shaky, when markets are all over the place, or when people are just plain scared of another big crash, what happens? We all demand a much bigger reward to take on risk. So yeah, this number, it's supposed to change. It has to change.
Okay, so how do people in finance actually pin this number down? For the longest time, the most popular method was, honestly, just to look backward. It's called the historical approach, and it's exactly what it sounds like. It's like trying to drive forward while staring into your rearview mirror.
And this is where that rearview mirror approach gets really messy. Just look at these numbers. Depending on which chunk of history you slice off, you get completely different answers. I mean, look at the decade from 2003 to 2012. It says you got paid less to take on risk, a negative premium. It just goes to show the number you get is totally dependent on when you start and stop the clock. So, which one of these is the right one?
But okay, let's be fair. What if you take the longest possible view? Go all the way back to 1928. Use all the data we have. You get this number, 4.2%. And you know what? For decades, this is what people did. They used a number like this in their models. It feels so precise, so scientific. It feels safe, right?
Well, not so fast. There's a huge catch. You see that 4.2%? It comes with some really important fine print, a statistical term called standard error. In this case, it's plus or minus 2.33%. What does that mean? It means that even with almost a century of data, the real, true premium could be anything from under 2% to over 6.5%. So that precise number? It's not precise at all. It's actually a giant fuzzy guess. So let's just recap the problems with looking backward. First, well, it's backward looking. Second, as we just saw, the numbers are incredibly noisy. And third, there's this huge problem called survivorship bias. I mean, all this data is based on the US market, which just happened to be the biggest winner of the 20th century. That's a pretty biased sample. And frankly, after the 2008 financial crisis, the whole idea that the future is just going to look like the past, that became a really tough pill to swallow.
So if looking in the rearview mirror is so problematic, what's the alternative? Well, thankfully, there's a much smarter, more dynamic approach. Instead of looking at the past, we can calculate what's called a forward-looking or implied premium. Basically, we're asking what premium is the market demanding right now, today?
And the best way to understand this is with a simple analogy. It's almost exactly like figuring out a bond's yield. With a bond, it's pretty straightforward, right? You know the price you pay for it today, and you know the exact cash flows, the coupon payments you're going to get in the future. So you can solve for the interest rate or the yield. Well, guess what? We can do the exact same thing for the entire stock market.
Here's the basic recipe, broken down into 4 steps. First, you start with today's price. That's the current level of the S&P 500. Second, you project out all the cash you expect to get back from the market, so all the future dividends and stock buybacks. Third, and this is the clever part, you solve for the one interest rate, the discount rate, that makes all those future cash flows perfectly match today's price. That number you solve for, that's your expected return on stocks. And finally, step 4, you just subtract the safe, risk-free rate. And voila, what's left is the implied premium.
So, what happens when you actually run the numbers? Well, back at the start of 2013, doing this calculation gave you 5.78%. Now stop and think about that. The historical number we talked about was 4.2%.
This is way higher. It tells you that at that specific moment in time, the market was feeling much more nervous. It was demanding a much bigger reward for taking on stock market risk.
And this is why it's so important. This isn't just an academic exercise. Imagine you're valuing a company, and you plug in that old, backward-looking 4.2%, but the real live market is actually demanding almost 6%. What happens? Everything is going to look cheap to you. You'll be running around thinking you found all these incredible bargains, but you haven't. Your ruler is just wrong. Your yardstick for measuring risk is broken.
Okay, that's great for the US market where we have tons and tons of data, but what about the rest of the world? I mean, how do you value a company in an emerging market like Brazil or India? How on earth do you figure out the risk premium there? Well, you can actually build one, piece by piece.
It's actually a pretty logical process. You don't start from scratch. You start with your base premium from a mature market, like that 5.8% from the US. Then, you need to add a little extra for that specific country's risk. A good starting point is the country's default spread on its bonds, basically the extra interest its government has to pay. But since stocks are riskier than bonds, you scale that number up a bit to reflect the extra volatility. You add that country risk on top of the base premium, and there you have it, a tailored equity risk premium for that country.
Okay, now here's a really important point. This is a game changer. A company's true risk has nothing to do with where its fancy headquarters is located. It has everything to do with where it actually does business and makes its money. So just assuming that a company incorporated in Brazil only has Brazilian risk, that's a huge, sloppy mistake.
And these examples just drive the point home perfectly. Take Embraer. It's incorporated in Brazil, right? But look at this. In 2004, almost all of its revenue, 97%, came from outside Brazil, mostly from safer, developed markets. So its risk profile looked nothing like Brazil's. And then you flip it around. Look at Coca-Cola, a classic American company, right? But its revenue comes from every corner of the globe, including tons of high-risk emerging markets. You absolutely have to factor that global risk into its valuation.
So, why all this focus on one single number? Why have we spent all this time on it? Because the equity risk premium isn't just some random input for a spreadsheet. It's way more than that. It is the very foundation of valuation.
You have to think of it this way. Whatever number you decide to use, it tells a story. It's your personal narrative about risk. If you use a historical premium, your story is that the world never really changes, that the past will always repeat. But if you use an implied premium, your story is about right now. It reflects all the current fears, hopes, and expectations baked into the market today.
And that really brings us to the final, crucial question you should always ask. The next time you hear someone on TV or anywhere else say the market is cheap or the market is expensive, pause for a second and ask yourself, is the market really cheap? Or are they just using an equity risk premium that's telling the wrong story?